Hello and welcome to ET Now. You're watching ET Now Masterclass, and my guest today is Raamdeo Agrawal, who is the chairman and co-founder of Motilal Oswal Financial Services. Raamdeo, thank you very much for joining us today on ET Now. To begin with, sir, 2025, we've seen a lot of work being done, not only from the government, from the regulator, and you take direct taxes, indirect taxes, interest rates, all have been reduced so that you have much more money in your hands. But despite that, we have not been able to get that momentum back in the markets, and the market has remained where it is actually.
Yeah. So, after post-COVID, index EPS was about 500, 445 or 500, around 500 in pre-COVID in 19. 20, of course, it went down. And then from there, it has doubled to about 1,000, 1,050. So we had almost 22, 23% growth between 20 and 25. So the market also responded with that, with a little bit of revaluation and all. But now, the moment election time came last year, I think the credit growth was completely stopped. And stop means it was brought down big time from 15, 16% to 8, 9%. So that deceleration killed the momentum in the economy. In any case, it was a kind of a matured kind of earnings cycle. It had to come to a stop. So with this, what happened was that earnings growth stopped, but domestic inflow in the mutual fund that remained continuous even till yesterday. So the people kept on buying. So if earnings growth has slowed down, market should have actually corrected by 20, 30% or 40%. That didn't happen because there was support from the retail. So we have a situation where earnings growth is not happening and yet the buying is on. So what is happening is it is giving time-wise correction. So P multiple is coming down because the earnings growth is now 10%, not 15% or 20%. So what has happened in market is just actually market is up 8-9%. If you look at the broader market, it is up 8-9% in last 12 months because that is what the earning growth is. Yes. So now it is for the authorities to figure out whether they want to give corporate earnings growth momentum or not, because your inflation is at 2%, 2.5%. Your tolerable limit is more 4%. So I think authorities from here onwards, my sense is that they will push the growth to 7.5%, 8%. Credit growth has to be 14, 15%. This will allow the nominal GDP also to build to 10, 11, 12%. I think 10% plus is very, very important for nominal GDP to grow.
And
because that also gives them tax collection. So how will the government function? In budget itself, there is a position about 10, 10.5% kind of nominal GDP growth rate. If that doesn't happen, the tax collection is not going to. So I think the policymakers, they are caught in this particular thing. To bring down the inflation, they kill the credit growth, and that killed the entire, machine.
Is it easy to revive that credit growth in that sense?
Yeah, it takes time. Even to kill it takes time. Revive takes as much time. You start slowing down the credit. They started slowing down the credit Q1 25.
25.
Sorry,
Q4 of 25.
24 for the election. And uska impact is visible in now. So clearly it took 1 year for it to completely slow down. Now what you have started, 125 bips cut in last 12 months. And now credit flow is improving. So I think we are at about
10, 11 now.
11 half. So once it goes to 14, 15, by March, I think we should be in 14, 15%. You'll see, the corporates just smiling.
2025, if you look at the index returns, as you said, total index returns were roughly around 11% odd. But we still underperformed the global markets and the emerging markets.
Yeah.
In 2026, if credit growth comes back to 14, 15%, and then that has a domino effect on other aspects of investment and consumption which comes in, do you see the markets outperforming in 2026?
See, at least I don't know what the market will do, because market has many other factors. I know one thing, that if you're, say, we have about 197, 198 lakh crores of commercial credit, bank credit outstanding. If instead of growing at 10%, which is 20 lakh crores growth next year, you will start growing at 15%. So that gives 20 plus 10, 30 lakh crores of additional purchasing power in the system. Because credit is very, very, discernible purchasing power.
Yeah.
It's not free all across. You have to take credit. So earlier you're getting 50,000 credit, now you'll get a lakh rupees credit. So that credit is a straight purchasing power, and that goes to basically all the what you call rate sensitive sectors like housing. It will go to the automotive. It will go to the large ticket items. So capital goods. So all those things will happen. You see those companies doing very well. So I think impact should be visible in the corporate earnings by Q3 itself should be better than what analysts are expecting,
Yeah.
and Q4 will be full blast, kind of a recovery. And I hope there is going to be further rate cut. You can't pay so much of real interest. So that's what the governor is indicating.
If you look at Q3 earnings expectation, it's going to be the best in 8 quarters in
How
that
much?
sense.
How much is the expectation? 8% they're saying, no?
8 to 10%.
8 to 10%. I think it will surprise.
We will
We'll
going
be
to surprise.
surprised. We'll be
And
surprised.
it's going to be the best in 8 quarters. Means
In fact, I was talking to a few banks on one-on-one basis. They are saying that they are looking at a bumper Q4. Bumper, that's the word he used. Bumper Q4. What it means, you have to see.
So how do you look banks? How is banks looking in this entire space?
Yeah.
Because we have seen in 2025, private sector banks have underperformed the public sector banks, and in the public sector bank, you have the HDFC banks of the world who have underperformed by a meaningful amount. Except for the ICICI Bank, where
Yeah.
we're seeing some growth coming in, and I think investors are also holding on to it. How do you see the private versus public? SBI of the world, which is one of the best
So
wealth
today,
creator for you.
I would think that PSU banks are cheaper to buy, and they have cleaned up their act, because whatever happened between 2008 to 2020, it got completely cleaned up in 2020. There is no directed lending from Delhi. So now these banks are really professionally managed. Technologically also they are more or less up to the mark, particularly the few of the larger banks. So I would think that why should there be so much of, in fact, there is no leadership crisis in public sector banks, because
Yes.
I mean, if somebody is appointed for 3 to 4 years, everybody knows that the system works with the 4 years of CEO leadership. In private sector, the banks are led by 15, 20 years of very charismatic leader, and when he goes, there is a problem. So I would think that large public sector banks like SBI and all, particularly SBI, looks very, very attractive.
And this is going to drive, you said, uh, rate sensitive sectors going in the next year or two, as credit growth, led by credit growth, which is
Yeah, so there
coming.
is a domino effect, there's a multiplier effect. You buy house, then housing leads to purchase of plumbing items, then furnishing items, so all kinds of labor and all, and what the labor spends on. So I don't know how it works in the economy, and nobody can figure out. But it will start with the rate sensitive, and then it will flow to the other consumption items. So overall, there should be a pickup as we go forward, quarter on quarter.
One of the biggest challenges which we are facing is with respect to geopolitics, right?
Correct.
India-US trade. Uh, you're talking about a trade deal which is now started impacting all the export sectors, actually. How do you look at it?
So you have to be careful. You have to see because it's not only America; it's the whole world. Multilateralism is changing, and this last 1.5 years of Trump's second term, everything looks topsy turvy. Every country is trying to become Atmanirbhar. Earlier Modi ji talked about Atmanirbhar Bharat, but now everybody wants to be Atmanirbhar. So they want to have unilateral, bilateral kind of a relationship in trading. America is targeting deficits country-wise.
Yeah.
So I think those things will have a huge repercussion. I don't know how the world will come out of this. Good thing is the countries with their own domestic demand. So the biggest asset is you don't have control over the global demand,
Yeah.
but you have control over your own demand. So how do you judiciously use this power of using your own demand? Fortunately, we are not that much dependent on exports. Yes, export is a very large portion. Services 50%, which is so far not impacted. Merchandise, you have all the challenges of this trade deals and all. But your domestic is completely yours. That's about 70-80% of the economy. So that part, how do you spend? It's an economy with what you call huge, consumption, appetite, I would say. And so how do you enhance the purchasing power? And see, and that's what government is doing. My sense is they're making the goods cheaper. They're leaving more money on the hands with the lower taxes, direct taxes, lower indirect taxes, lower cost of money, and more credit. So all the, I think, government has done everything, and they can do more of the same thing in the coming budget.
One of the things which we've seen because of this time correction that has happened, domestic flows maintaining the index at 26,000,
Yeah.
and while earnings have been tepid at 8 to 10% every year, which is growing, is the derating of some of the classes of stocks, which were trading at a very high PE, where we have seen now earnings growth is also now a questionable thing. Your P is around 5 times your earnings growth, which is coming in some of the cases. How is it a time to look at these stocks with a different lens?
Yeah, I mean, this is always a, see, when a market is the craziest stuff. Mr. Market will either they'll be very depressed, or the growth is 20%, but they will give you a multiple of 10 or 12 or 15, like banks. Okay. Why the PSU banks have done very well? Because they were trading at 3, 4, 5 P multiple.
Yeah.
And they were growing at 15, 20%. So obviously it was a half peg or less than half peg. So it did very well. And then you go overboard when some of these fancy companies, they start growing at 40, 50%. They will take it to 100, 150, 200 P. Any price is right. High growth, high quality, high growth, any price. Then you suffer, no? Because ultimately stocks are stocks. I mean, you are buying a dividend paying earnings machine. So you cannot pay a very high price. You just cannot pay high price. Just because there is momentum, a lot of speculators come. I mean, a lot of fund managers, they look to be investors, but they're actually speculators. So they speculate on ki bhai, agle saal again, there's going to be 80% growth in the profit, and hence I can get 40, 50% return on the stock. But for some reason or other, maybe credit growth has gone or something, the earnings decline. Earnings don't grow at 80%, but it grows at 20, 25%. So the 20, 25% is damn good earning. But stock is building in 80%. There is a disappointment. So market will, I mean, all these speculators, they come to sell and there is no buyer.
Some of the Baki stocks, like a Trent, which are trading at multiple 80, 90, 100 PE, at that time growing at 40, 45%. And now, suddenly we're seeing that the company itself saying that I'll grow at 20 to 25%.
Which is
and,
fantastic.
and reach, which is a very good growth,
Yeah.
but much below street expectation, which is there. Is it time to still hold on to that kind of
You need to know a
story?
lot more. You need to know a lot more for me to say anything on this. So I would not comment on what to do in trend. But yeah, I mean, the company is not victim of anything. Company is going at the pace at which they're doing brilliant job. Judios, ye wo sab kar rahe hain wo log. But I mean, if you do excessive pricing of the stock, then of course stock will be victim of correction, not the company.
And that you'll see it's many of the stocks where
Lots of them.
where the growth has now
This is
tapered
very
down.
famous stock, but the whole lot of it, and that's where I think the excessive valuation which has happened in last 4, 5 years, because there was a demand shock when the retail investors started coming in 2020. 30 lakh investors every demat accounts opening. Obviously, there was a massive demand for the paper.
Yeah.
So the mutual fund, through the direct, in all kinds of speculative as well as investing. So when there is a demand shock, so stocks started flying, and the stocks which were small, what you call float, they flew more. The ones which are big, the speculative tendency was not there to go there. So now there is a supply shock in the market. All kinds of IPO, QIP, promoter selling, FI selling, everybody is busy selling the paper. But my retail is also so robust, so there is a kind of a floor. Market is not going below 26,000 or 25,800 or whatever is the number. It is sticking at around 26,000. All kinds of bad news are flowing through, and yet market is steady at about 26,000. So which is a terrific resilience,
But we always say that foreign flows is something which drives momentum in the market.
Yes.
That momentum is absent for last 12 months.
Yeah, it will remain absent for next 12 months again, because see that's the arbitrage machine between India and rest of the world. It's a pipe between India and rest of the world. When you imagine, it's like if you are at 25p and rest of the world, I'm a relevant world, like I'm saying, emerging market is at 15p. Which way money will flow? The guy is sitting in first thing, America itself is doing so well. So very little money is coming to the emerging market. Now, whatever little is coming, money will definitely. So money is not coming actually. So what people are doing, people are readjusting the allocation. So India has become the funding market for rest of the emerging market. So if you want to go to China, where it is say 15p, where at 25p, so they are selling say 20% in India, because India is giving the liquidity as well as the price.
Yeah.
You are selling here and buying at 15p in China. And that's why they have done very well in last 1 year. Now, so my sense is there are only two ways to counter the FI selling flow. One is that we come down to, my P multiple comes down to 18, 19. Now, P multiples to come down to 18, 19, there are two ways. One, you actually correct the market, which is not happening. Second, your earnings take a kind of a flight.
Right.
So in next 1 year, if earnings grows at 20%, then that 22 becomes 18 in any case. Yeah. So then FIs will actually come. So if the earnings growth, earnings momentum pick up, I don't have any doubts. All the FIs will be sitting here.
And do you think that earnings will go up to 15 to 18%?
This is this we have to see. I mean, you are in the channel. You can pick up all the nifty companies and interview them in 2 days. I mean, I don't have that kind of capability.
But from your experience, do you see this kind of thing, because we are talking about a credit growth picking up, the multiplier and domino effect coming in, and then may not be in a quarter or two, but maybe in 3 to 4
Yeah.
quarters, how this
I would be very bullish I would be bullish on the earnings growth for next 12 months. Market, what they will do, whether they're correct or, I mean, whether the P multiples will go up or stay here or go down, I don't know. But earnings should pick up in next 12 months.
If you were to come to Coimbatore very specifically,